Gold touched $5,500 in January. Then, during the largest disruption to the global oil supply in the history of the market, a war, a closed strait, oil surging past $100 a barrel, gold did the one thing almost no one expected. It fell, roughly 20%, while the world was on fire. Most people looked at that and drew exactly the wrong conclusion. The rally was a bubble. The safe haven trade was over. Gold had failed the one test it was supposed to pass. That conclusion is not just wrong, it's the exact opposite of what actually happened. Because here's what nobody is telling you. The first time gold reaches a level, and the second time it reaches that same level, are not the same event. They are governed by different forces. They produce different consequences. And the moment gold crosses $5,000 a second time, from below, it stops being a number on a chart. It becomes something the entire monetary system is forced to bend around. In the next 25 minutes, I'm going to show you why gold fell when everything said it should soar, what that fall actually revealed, and why the second crossing changes everything in ways the people staring at the daily chart will keep missing. Stay with me. Because the number is not the point. What the number forces other people to do is the point. Before you can understand why the fall was actually evidence for the thesis, you need to understand what actually drove gold to $5,000 in the first place. Because the popular explanation is wrong at the root, and everything downstream of that error leads people to the wrong decision. This move was not built on retail speculation. It was not people chasing a trend on their phones. The engine underneath it was central banks, the institutions that manage and issue the currencies of entire nations, buying physical gold at a pace not seen in modern history. Roughly 1,000 tons a year, about double the historical average, sustained now for 3 consecutive years. In the first quarter of this year alone, total gold demand reached a record 1,231 tons, worth a record $193 billion. That is not a crowd of speculators. That is the most informed capital on the planet, quietly and deliberately moving out of paper reserves and into metal. And the reason traces to a single event that rewired how every central banker on Earth now thinks about safety. An event most people have already forgotten, but that nobody who understood it will ever forget. When Russia invaded Ukraine, the United States and its allies froze roughly $300 billion of Russian foreign reserves. Overnight, dollars and euros that belonged to a sovereign nation, rendered unusable. Now, set aside how you feel about that decision politically. Think only about what every other central bank in the world learned from it. The dollars they hold can be frozen. The euros they hold can be frozen. Reserves denominated in someone else's currency are only as reliable as that someone else's permission to use them. But gold sitting in your own vault, on your own soil, cannot be frozen, cannot be sanctioned, cannot be switched off by anyone. In a single moment, the world's central banks discovered that the assets they believed were the definition of safety carried a hidden vulnerability, and gold, the oldest and most primitive reserve of all, suddenly became the one asset with no counterparty and no off switch. That realization is the engine. And here is the critical point most commentary misses. That realization does not reverse when the price of gold pulls back, because the vulnerability it responds to has not gone away. The freezing of reserves is not undone. The lesson is permanent, which means the buying is structural, not emotional. Now hold that. Because here is where the 20% drop actually fits, and why it is evidence for the thesis rather than against it. Two forces hit gold at exactly the same moment, both temporary, both brutal, and both completely unrelated to whether gold should be owned. An oil supply disruption drives inflation expectations higher, because oil is embedded in the cost of nearly everything. Higher inflation expectations force the central bank to keep interest rates higher for longer. Higher for longer rates push bond yields up. And when a government bond reliably pays you 4 or 5%, gold, which pays you nothing, becomes relatively less attractive at the margin. At the very same time, capital fleeing the chaos floods into the dollar as the reflexive safe haven. And a stronger dollar mechanically pushes down the price of dollar-denominated gold for every buyer on Earth. So gold did not fall because it stopped being money. It fell because the acute phase of an oil shock stacked two temporary forces on top of it at once, rising real yields and a surging dollar. Those forces are transient. They fade as the shock is absorbed. The central bank accumulation underneath does not fade. And this is the entire key. The thing that pushed gold down was temporary. The thing pushing it up is structural. When the temporary force exhausts itself, only the structural force remains. This is why the second crossing of $5,000 is a completely different event from the first, and why everything changes even more once it happens. What I'm about to show you is the mechanism nobody is watching, and it's the one that actually decides what happens to your savings. Stop for a second. We've covered the engine, central banks buying at record pace. We've covered the event that rewired their thinking, the reserve freeze, and we've covered why the 20% fall was temporary mechanics, not a broken thesis. What comes next is the part that most analysis completely misses, because it's not about the price of gold. It's about what a durable price of gold forces every other actor in the system to do. And those forced responses are what actually determines where your savings end up. If you've stayed this long, this next section is the payoff. Think carefully about the mechanics of a price level. When a price is being discovered on the way up for the first time, it is fragile. It depends on continued enthusiasm, on momentum, on the marginal buyer staying excited. That is why a 20% correction can knock it down so quickly. The weak hands get flushed out. The momentum chasers liquidate. The leveraged speculators receive their margin calls, all at once. But when a price is reclaimed from below, after a violent shakeout, with the speculative excess already purged and the structural buyers still accumulating through the entire decline, something fundamentally different happens. That level stops being a fragile destination and becomes a durable floor. And a durable floor is not just a higher price. It is a reference point that every other actor in the system is now forced to respond to. A central bank that was hesitating now sees its peers accumulating and its reserves depreciating, and it accelerates its own buying rather than be left behind holding paper that is losing value. An institutional allocator who dismissed gold as a barbarous relic now faces a durable floor that has changed gold's entire risk profile from speculative to structural, and is compelled to add exposure. Each of those responses adds real demand. That demand reinforces the floor. The stronger floor sends a louder signal. The louder signal forces more responses. This is a self-reinforcing cycle, not because of the number itself, but because a durable floor converts gold from something people gamble on into something the system is structurally obligated to reckon with. Now let me connect this to the force that guarantees the pressure continues, because this is where the monetary system and the fiscal system collide, and where the math becomes impossible to escape. The United States carries a national debt approaching $40 trillion. The annual interest on that debt has crossed $1 trillion, more than the entire defense budget, consuming roughly 19 cents of every single dollar the federal government collects in revenue. And no amount of skill or credibility can make those numbers work at sustained high interest rates. Here is the trap stated plainly. At these debt levels, the government cannot afford to sustain high interest rates indefinitely, because every additional month of elevated rates adds tens of billions of dollars to the interest burden, which widens the deficit, which requires more borrowing, which demands either higher rates or more money creation. There is no clean exit. And the historically consistent resolution to a debt burden of this magnitude is not repayment. It is financial repression, deliberately holding interest rates below the rate of inflation, so that the real value of the debt quietly erodes year after year. while nominal growth shrinks the burden relative to the economy. This is precisely how the United States worked down its enormous World War II debt. It is a proven mechanism, and it has a victim. The victim of financial repression is the saver who did everything right. When interest rates are deliberately held below inflation, the retiree holding cash and bonds watches the purchasing power of those holdings decline every year, even as the nominal balance on the statement looks perfectly stable. There is no crash, no headline, no moment of panic, just a slow and relentless transfer of wealth, away from anyone holding paper money, and toward anyone holding assets whose supply cannot be expanded by a policy decision. And this is exactly why a durable gold price above $5,000 matters to an ordinary person who owns no gold at all. Because that price is the alarm on the silent process. When the most informed institutions in the world are moving their reserves into an asset that cannot be printed, they are telling you with real capital, not opinions, what they expect to happen to the value of the money you hold. A durable gold price above $5,000 is not a number to celebrate. It is the market making visible what the erosion of paper money is doing beneath the surface, to every dollar in every savings account. Now let me place this in historical context, because the pattern is not new, and the precedent is instructive. Through the long gold bull market of the 2000s, gold cleared one psychological level after another. $300, $500, $1,000. Each of those levels, once reclaimed after a sharp correction, became the base from which the next advance launched. The corrections along the way were brutal. Drawdowns of 20, even 30% were routine, and each one convinced a fresh wave of holders that the move was finished. But the structural driver of that era, a steady erosion of confidence in how paper currencies were being managed, never reversed. And so each reclaimed level held, and the metal climbed for a decade. The difference today is that every one of those structural drivers is now present in a more extreme form than it was then. In the 2000s, the national debt was a fraction of what it is now. Central banks were net sellers of gold, not record buyers. Reserves had never been weaponized on the scale the world has now witnessed. Every condition that powered the earlier repricing exists today, amplified. The daily price tells you what traders did yesterday. The floor tells you what the most informed institutions on Earth are preparing for over the next decade. Here's the one thing worth watching, not a specific price to celebrate. One behavior, whether gold, after reclaiming $5,000, behaves like a base rather than a ceiling, because that behavior, more than any single figure, is the system telling you how much confidence remains in the paper money that denominates your savings, your wages, and your retirement. Here's what I want to know from you. Are you watching the daily price, or are you watching the floor? And if you're holding physical metal right now, tell me whether you added through the 20% drop, or whether you sold. Because the answers to those two questions tell me more about where you'll be in 5 years than any chart. Drop it in the comments. I read everyone. Here's what's coming next. This video established the thesis, why the second crossing is a different event and what it forces the system to do. The next one goes into the specific mechanism of financial repression, how it has been implemented historically, what it looks like while it's happening, and which assets have actually protected purchasing power across the 2 decades it takes to run. Subscribers get it first. Subscribe. Hit the bell. Because the silent tax doesn't announce itself, and neither does the floor that protects you from it. Learn to read the difference, because they will not always point the same way, and only one of them has ever mattered.